Hello, everybody. In Module 2, I talk about feedback effects. Module 2 has 6 lessons. Today, we're focusing on Lesson 1. I'm going to provide a brief big picture introduction to the feedback effects and link to subsequent lessons in this module. First, I would like to review what we learned in Module 1, because this serves as a natural motivation to what we're going to talk about in Module 2. In Module 1, we provide a first glance at how information economics models are different from traditional microeconomic models you may have encountered. A key difference is that in traditional microeconomic models, price only plays an allocation role. Demand equals supply that determines the market clearing price. In information economics models, price has an additional informational role. It aggregates information from privately informed traders. Such aggregation, however, has to be noisy. It cannot be perfect, because as pointed out by Grossman-Stiglitz, if such aggregation is perfect, everybody is going to learn about the information from prices. Nobody is going to acquire private information. But if nobody acquires private information, how can prices aggregate information from privately informed traders? We also learned that uninformed traders, even though they do not have information, they're going to try to infer information. How are they going to do that? They're going to put themselves into the shoes of the informed traders. They're going to conjecture informed trader strategies as a function of their private information. Such conjecture, however, cannot be arbitrary. It has to be reasonable. And in equilibrium, they have to be the same as the optimal choice by the informed traders. We also talk about two different market structures: perfectly competitive, when price is taken as given, and imperfectly competitive, when some traders have market power. They know their demand affects prices, and they take that into account when choosing their demand. Regardless of how prices are formed, depending on different market structure, prices aggregate information. The natural assumption is that managers, firms, they can learn from prices to guide their real decisions. And this is the key assumption underlying the feedback effect literature that we're going to talk about in Module 2, the feedback of prices into real decisions. However, to study feedback effect, we cannot use the Grossman-Stiglitz or Kyle model that we learned in Module 1, because in those models, the future firm value or terminal cash flows are exogenously given. So there is no real decisions to be made. We need a model when real decisions are being made, as we're going to talk about in this module. And we are accounting researchers, so we care about disclosure. And the natural question is, in the presence of feedback effect, when markets have some information that the manager does not know, so the manager would like to learn from prices, what role does disclosure play? As disclosure is usually about the information that the manager knows, but the market does not know. We're going to discuss this issue in lessons 5 and 6. A key insight from the feedback effect literature is that price efficiency and real efficiency is not necessarily the same. You may think this is not correct, because a knee-jerk reaction from the feedback effect is, if managers can learn from prices, then the more informed the price is, the more efficient price is, the more efficient the real decision is going to be. So price efficiency and real efficiency has to move in the same direction. However, in lesson 2, we're going to show a flaw in this logic. If managers can learn from prices, then price is going to anticipate such learning. But at the same time, if managers does not learn from prices, price is going to anticipate such no learning as well. So in this case, managers is not going to learn from prices, and price is going to anticipate managers not learning. The conjecture becomes self-fulfilling. In this case, price is very informative, because price reflects that the manager is not going to learn from prices. But real efficiency is going to suffer. Therefore, feedback effect is going to generate a wedge between price efficiency and real efficiency. For more details, check the review paper by Bond, Edmonds, and Goldstein. Considering feedback effects makes a difference, and that's why we have this module. Recall from lesson 1 that one reason we need theory is we have some counterintuitive results, and we're looking for an explanation. By exploring the divergence between price efficiency and real efficiency, feedback effects offer the potential to provide such explanations. And we're going to see examples that we're going to discuss in more detail in subsequent sessions. And we're going to see that the phenomena would not arise without feedback effect. So feedback effects is vital. The first example is the asymmetric trading of private information. Without feedback effect, and if we assume that trading costs are the same, and trading on private information would be symmetrical. If I have good news, I'm going to buy. If I have bad news, I'm going to sell. However, with feedback effects, we're going to see that trading on bad news is going to be less profit. Because when you trade on bad news, you're anticipating that the firm value is going to decrease, so you're going to profit by selling. However, when you incorporate feedback effect, when the manager learns from the trading that there is some bad news, the manager is going to take corrective actions. Such corrective actions is going to increase firm value, and it's going to decrease the profit from trading on bad news. As a result, there will be less trading on bad news, so less information acquisition of bad news. In this case, price is still efficient. You have less acquisition of bad news, there's less bad news in prices, price reflects that. But real efficiency is going to suffer because there is less bad news incorporated into prices that can be learned by the manager. We're going to learn about this in lesson 3. In lesson 4, we're going to talk about what we call manipulative short selling. Manipulative short selling means that even for uninformed speculator, they're going to short sell. Without feedback effect, this is not going to happen. Because the market maker is going to price protect itself if the market maker thinks that the speculator is likely informed. The market maker is going to set the price moving against trading direction of the informed speculator. Price is going to increase when the speculator buys, price is going to decrease when the speculator sells. But if you're uninformed speculator, you expect the firm value to be the average. So price moving against you is going to result in you losing money if you trade. You're not going to trade. However, with feedback effects, short selling might be optimal even when the speculator is uninformed. Because the manager does not know whether the short selling comes from informed or uninformed speculator. And so the manager thinks there might be something in the short selling. So the manager is going to take some action as if bad news occurs. But in fact, there is no bad news. And such action is going to reduce firm value. And this is going to make short selling profitable. However, in this case, buying is never going to be optimal. Because if you choose to buy, the manager thinks that there might be some good news. And so the manager is going to take action as if good news occurred. But there is no good news. So such action is incorrect. And such incorrect action is going to reduce firm value. And it's going to make buying even less profitable. And so with feedback effect, uninformed speculators, they have incentive to short sell, but they don't have incentive to buy. This provides explanation for so-called manipulative short selling, which refers to speculators spreading rumors when they don't have information to bring down viable businesses. The third example, and we're going to talk about in lessons 5 and 6, and we mentioned earlier, it's related to managerial disclosure. Without feedback effect, if a manager wants to maximize firm value, the manager is going to be indifferent to whether or not the manager is going to disclose, because the manager does not learn from the market. So disclosure does not change firm value. With feedback effect, however, the managerial disclosure issue becomes non-trivial. The manager needs to consider whether or not to disclose, and if the manager chooses to disclose, what type of information to disclose. We're going to see that the manager may not want to disclose information, because if the manager discloses information, then the informed trader has no information advantage, so they're not going to acquire information. And there would be no learning from the stock price. When learning is important, the manager may not want to disclose information to induce such learning. We are also going to see that the manager may want to disclose the information that the manager already knows a lot about, and the manager does not want to disclose information that the manager does not know a lot about. Because In this case, the manager can induce the informed trader to trade on the information that the manager does not know a lot about, so the manager can learn. And so whether and how managers disclosing the presence of feedback effect is quite subtle and nuanced. So we're going to need 2 lessons to discuss about it. To conclude, incorporate feedback effects generates a wedge between price and real efficiency, and it has the potential to explain many seemingly counterintuitive phenomena. We already gave some examples about that. In the next lesson, we're going to use a simple example to illustrate how feedback effects may generate a wedge between price efficiency and real efficiency. If you want to test your understanding of this lesson, check out the review quiz on the link provided in the slides. Thank you very much.